Hi guys, in this video we are going to look at the cash flow calculator, which is very important when you're about to buy an investment property. You might be evaluating between a few properties in a suburb, or you are just trying to understand the current cash flow of an existing property investment which you have made. So very excited to go through that cash flow calculator, which is really helpful. And if you guys need the calculator, just feel free to message me on this video or reach out to us at info@nationalpropertyconsultant.com.au, and we'll be happy to share the calculator with you. So the cash flow calculator has a few things. So just from the high level, it has got all your property purchase expenses, that is a one-off expense which you do when you're buying an investment property, which is generally the capex sort of thing in terms of the business terminologies. And then you have the operational expenses, which is how much interest you are paying, what amount you are giving to the property management companies, or if there are any other maintenance charges or insurances, etc. So that your capex plus your opex and your income, that means whatever rental you're getting from that investment property will give you the cash flow on that property. In this calculator, we also try to understand how the cash flow will look like in year one after making the purchase of the property, and then we try to extrapolate it with some assumptions that how the cash flow and the capital growth will look like down the line after 3 years, 5 years, up to the 10 years. So without much ado, let's see how it looks like. So from column B to column E, we have sort of a capex expenses. These are one-off expenses when we are making the property purchase. The first one is the purchase price, how much we have paid to buy the property. And then we have any other expense related to that purchase, which could be your stamp duty, which could be your legal fees, or any equity you have deposited. And it also considers how much cash you have deposited to make that purchase. And all this helps to come up with the cash flow on that property. And then we have some initial expenses in terms of the loan expenses, and also the property valuation, any lender mortgage insurance if we have paid, or any other loan cost that might be very specific to the type of property, or where you are buying that property. It could be the build and best inspections, or it could be just the normal inspections for which you are paying to the local agents or anybody else in that area to just take a video of those properties and send it to you. So this is what the purchase expenses or the capex looks like for this property. And then we have the operational expenses, which are the sort of annual expenses which we need to pay to maintain that property. So in the annual expenses, you can have rates, which are the council rates, and then you can have the insurance building, and you can have the landlord insurance as well. You could have a body corporate if you have, sort of bought a place which has a body corporation. You would have the land taxes, you might have the cleaning, service contracts, you could have garden or lawn maintenance, some sort of assumptions. We can make dependent on the property, and we can have some other expenses as well. So just taking $1,000 in this case. So in this example, we have bought the property in $450K, and out of that $450K, we have given $100K from our deposit, and we have some other expenses as well. So total expenses $115K, which gives us our loan amount is $350K, and then the total equity funds which we have used is $16,100K, and that means the $350K, which is 450 minus 100, is $350K plus all the other expenses which we had, which we are also taking loan, So the total funds which we have borrowed is 366K, which gives us the LBR of 81%. When we add up all these annual expenses, it comes out to be $28,850 yearly as the operational expense on that property. And I'm using these terms operational expenses because end of the day, property investment is a business. That's how the ATO treats property investment. So in terms of using those terminologies, the one-off expenses which we have used to buy that asset is the capex, and then we have the operational expenses. And the third part is the annual income from column L to column O. So we are saying that on that property, we are getting a rent of 540, which is very, very realistic if you actually know the areas to buy the property. And this data is an example, but it is actually the real data for one of the clients which we have bought recently, property investor in Australia, and the market price or the purchase price was 450. It was advertised at about 468, if I'm not wrong, but we did a bit of negotiations, etc. We bought it at 450K, and the rental in that area is 550. The current tenant was paying 520, and he agreed to increase the rent to match to the market rent to 540. And the owner or the buyer, in that case, our client is happy to keep the current tenant at 540 rent per week. So that gives us the rent per annum as $27,000, and then we have some sort of tax calculation here. We are doing the tax calculation because we are trying to calculate the non-cash deductions as well when we are trying to get to that number of the cash flow. So this will help us, because in this case, it is actually not much of a difference because we have an annual expense of 28,850, and then we have the annual income as this. So we are in loss yearly of about $1,850, and because that is a loss, and if the property is in your name, individual name, you can claim your taxable income be reduced by 1,850. So that would be your saving on the taxes you are paying to the ATO. This property in this case was built, I think, in 2006, and based on this calculator, the depreciation that came out is about 7,000 for first 4 years, and then we have about 5,000 from year 5 to year 10. So that gives us a total depreciation of 58,000, and we'll see how the depreciation affects the cash flow. So here we have the total capex, we have the operation expenses, we have the income, and we have some other factors which will affect our cash flow. Now we're gonna see how the cash flow looks like. So in this case, we have all the capex here, and then we have operational expenses also in here. Then we have the cash deductions, which is the interest amount we are paying, and this will give you any pre-tax cash flow per week. And then we have non-cash deductions, which are depreciations and any other tax refund which you'll get from the ATO. And based on that, it will give you the cash flow on that property. Now, if you see the cash flow per week is a positive number, that is, in this case, it is about $4 per week, which is a good achievement considering the current interest rate, etc. To get to this number where we have the $4, or I would say we are not just paying anything for that property. So the property is self-sustaining, and we are the ATO and the tenant. It's mostly the tenant which is paying 94% of the expenses, and the ATU is paying about 7% of the expenses in this property. So this is how it looks like. We have market value. We are assuming we have done some assumptions here that the inflation rate is 3%, which is, I know, is totally wrong at this moment of time because it's quite high, or at more than double at this moment of time. But this inflation, etc., is not used to calculate the cash flow. The inflation is used to extrapolate how much more income we can expect, because we are saying that the rental will increase by the same amount as the inflation rate. So we're saying it's 3%. That is, we are saying the next year the rental will increase by 3%. If we put 7%, then the rental will say it will increase 7%, because we're saying the rent will increase along lines with the inflation rate, which is not always the case. So this is a bit of assumption. So this gives us a very close number, some good idea about the cash flow. But a lot of property investors, they actually, sort of put the actual numbers in year one, how it's performing, to keep track of the portfolio. We have the loan interest rate, which is 5.5% in this case. And then we have a capital growth, which is about the national capital growth of 7%. And by putting these numbers, we are saying that with that capital growth percentage, the value of the property will go from 450 to 481 next year, which is very, very realistic, and provided you have selected the right area. And provided, right, it's a lot of factors that influence the capital growth, etc. Some things are in your control, some things are not in your control. But eventually you will get the growth if you have selected the right suburb, right location, right pocket in that suburb, and the right property. So, and your loan amount remains same in this case, because we are doing just the interest only loan for the investment properties. Then we have the LVR reducing every year, and then you have equity in the property increasing every year, and then you have deposits, which is increasing in terms of the percentage every year. Your available equity is increasing here every year, which can be used to buy the next property. Your rental, we're saying, is increasing. It's calculated based on the inflation rate. So your gross yield is 6%, your net yield is 4.1%, which is pretty okay. And you need these kind of yields to actually handle the current interest rates. Excuse me. And then you have the total interest payments, which is again based on 5.5% interest rates. You have some annual expenses, you have pre-tax cash flow, you have pre-tax then cash flow per week. So, and after that you have the depreciations, you have the tax benefits. It's not much in this case because we have put the salary of the buyer as 100K, but if the more salary you have, basically you'll get more tax refund. That doesn't mean that you'll buy a property where the yield is not, but you still try to get the property which in itself is sustainable and in good areas. Yeah, so in this case it looks like $4 coming into the pocket, and that's annually your cash flow. And that's every year your property is growing by these many thousands in terms of the capital growth. So year 10, your property value will be 885,000. So if you decide to sell it in year 10, which we don't recommend, by the way, we work on most of the time we recommend to hold the property as far as you can. And that's why it's very important to actually work out the cash flow. Because if you have the self-sustaining property, which means that the income from the property is more or, nearly equal to the expenses of the property, that means you don't need to pay from your pocket. So you can, hold it as long as required. So year 10, the property value is this. If in case you decide to sell it, then you can, sell it. Most likely you get lumps this much of amount. You pay the loan to the bank, and that means you have actually made 885 218 and minus 366 100 as the net profit on that property. After that, of course, you need to put the capital gain taxes, etc., and whatever other expenses you will have, and that will give you the profit on that investment. So that's how the cash flow calculator looks like. In case anybody wants to get access to this calculator, feel free to put a comment in this video or reach out to us at info@nationalpropertyconsultant.com.au. See ya. Bye.